Thanks for tuning into the Weekly Wrap. My name's Jessica Amir, an equity analyst at Bell Direct. Well, the Australian share market looks set to close off the week with a fall of 2.5%, our third weekly loss. Today, the benchmark S&P ASX 200 rose about 0.5% following Wall Street's slight bounce back on expectations of some kind of a trade truce, which we'll touch on in just a sec. However, zooming out, looking at the year, the top 200 or the S&P ASX 200 has gained for 25 weeks this year, with 16 weeks being negative. That's including this week, which leaves us with a total gain of 15% this year. Including dividends, the return is even better and stands at 22%. So let's say if you invested $10,000 at the beginning of the year, it would now be worth about $12,200. Meantime, over in the US, despite Thursday's slight gains, the US major indices are headed for their third straight weekly loss as well. The S&P 500 is down 1.7%, while the Dow 30 is down the most, 2.3%, and the tech-heavy Nasdaq is down the least, 0.9%. This could all, of course, change as this evening the US government is set to release the country's monthly jobs report for September, and we're expecting 100,000 jobs to be created in September. That's less than what the market is expecting of 150,000 jobs. But let's go back to the numbers or the returns for the US, just as we did for Australia. This year, the benchmark S&P 500 has jumped about 20% or 19%. So if you invested $10,000 at the beginning of the year, it would now be worth about $12,000, and that's including dividends. But in terms of standout stocks, stay tuned for next week as we dive into outperformers in both of our major markets. Also, looking at the week, what fueled this week's slowdown or pullback from our bull run? Well, in Australia, the RBA, of course, cut the cash rate by 0.25% to 0.75%, a new historical low as expected. It's the third cut this year following the cuts that we saw in June and July. We can expect another rate cut of 0.25% in November. And UBS today coming out saying that they expect the RBA to cut the headline interest rate to 0.5%. Well, that factors in a rate cut of 0.5% next month instead of UBS expecting a cut in December. We're also expecting the RBA to continue to cut rates towards possibly 0.25% in 2020, really to meet their headline inflation rate target of 2.5% and their unemployment target of 4.5%. Well, not only are the major banks not passing on the full rate cut, but the nation's stimulus or tax cuts that we saw earlier this year are not proving to be beneficial, and that's according to today's data. It comes as we saw the retail sales come out today, showing a rise of retail trade by 0.1% in August. That was missing the expectation or the market expectation of a rise in retail of about 0.5%. Over in the US, what came out this week? Well, of course, that weaker than expected manufacturing data. And as manufacturing, the data unexpectedly fell deeper into the red for the second month, it really flagged those selling fears. It was the worst activity in 10 years. And this is one of the reasons that we did see local equities and global equities pare back and fall so hard in our last two trading sessions, as manufacturing makes up 10% of the US economic income. Also in the US, we also received weaker than expected services sector data, a reading to be exact of 52.6, and it's still above the 50 break-even point. But it was a big fall compared to the 56.4 reading. As services makes up about 90% of the American economy, it appears to be a bittersweet reading or bittersweet news. What I mean by that is it is a fall in activity and it's not good for the nation in terms of a dampening in their income. But traders feel it's a solid signal to Trump and his government that the trade war and his $300 billion in tariffs is having a real significant dampening effect on the economy. namely manufacturing and services. And because of that, the market is now expecting the government to come back to the party and expect to deliver some type of trade war reprieve. We also saw the World Trade Organization, or the WTO, greenlight $7.5 billion in new tariffs on European goods. That includes a 10% tariff on European aircraft, as well as a 25% tariff on European agricultural products. And in terms of strategy, do stay tuned. Next week we'll be diving into standout stocks that you may like to get your hands on, and also to take advantage of the specifics that we've covered today. Thank you so much for your company for my first week at Bell Direct. My name is Jessica Amir. See you next week.